thank God we use a lot of data to construct our narratives, but other investors may use less data. I doubt there's any investors using more data to construct their narratives. I just did put out a report that had 170 slides yesterday, 172 slides yesterday. I don't know anybody pumping out 100 plus slide presentations every month by themselves on Global Wall Street. I think I'm the only person on earth doing that. I'm happy to be the only person on earth doing that because look at our track record, it's working. So, but anyway, the whole point I'm making is, the reason we separate church and state from a quantitative risk management signaling perspective and a fundamental research perspective, like all the best hedge funds in the world, by the way, the ones who charge 3 and 30, the ones whose buildings I've been in and out of for the past 16, 17 years, they do the same thing. And the reason why it's because, it's you can change your positioning faster than other investors responding to a quantitative risk management signal than you would changing you're responding to a change, a dissipation, or the evolution of a theme. It's a dissipation of a theme. We get wedded to our fundamental beliefs, and it's how you got to prime out of our cold, dead hands. But a risk management signal will chop your hand off and say, no, you can't be long that anymore. Or no, go work somewhere else, which is why, we do a lot of what we do. A lot of what we do is to help our clients stay in the seat. And it's hard to stay in those seats. That's one of the hardest jobs in the world is being a pot shop PM. And so I salute all of our pod shop PMs listening to me rant right now. Appreciate you guys. Thanks for partnering us. And just know that we're working, as hard as you guys are to stay, to keep you on the right side of market risk, because that's a beast of a job. So keep moving here. So let's get into the fundamental portion of the program before we wrap up. The Powell Fed may be in the process of making yet another policy mistake, ironically, to protect Jerome's legacy from their previous policy mistake of letting the inflation genie out of the bottle. We had tamed inflation until this man came along and tried to promote maximum and inclusive employment and support the green transition and the man had the Fed funds rate 1,000 basis points below what the Taylor rule suggested it should have been in 2021. Fed balance sheet got up to 36% of GDP after averaging 0% of GDP prior to the global financial crisis. I mean, I understand it. Like, I get it. 2 wrongs don't make it right. I get it. They don't want to make the same mistake again. I get it. But the problem is their insistence upon not making that mistake is causing them to make another mistake. You see what I mean? Instead of just running sound monetary policy, they're running monetary policy to prevent making the previous mistake. And this is what all central planners do. They're always chasing the previous crisis. That's what central planners do. This is why you got to let markets and the free markets decide. Why? By the way, we have blockchain technology. We got all sorts of ability to implement sounder monetary. But I guarantee you, ChatGPT is better at implementing monetary policy than the Federal Reserve. Probably better than all of us. We're not willing to go there yet, but at some point we'll get there. Why is 19 people sitting around a room voting on the price of money? It's the stupidest thing I can think of in 2025. We've got a cabal of people sitting around a room voting on the price of money for the whole world. It's absurd. It's literally absurd. But anyway, as long as we're going to continue with this absurdity, we just know that, hey, the data is starting to soften and they probably should be pushing through more policy rate cuts to preserve the business cycle. But right now they're trying to they're demanding getting to 2% inflation. And boy, we're going to land this plane on slide 64 shortly. But let's get to this. So as we all know, our friend Adriana Kugler, who did not vote at the FOMC on Wednesday, just resigned. So now she was expected to leave in January, which is the person that was the board seat that the Trump administration was likely to replace. That person that they nominated to replace Kugler was likely to become the next Fed chair, because they can't run the risk that Jay Powell, when his term as Fed chair ends in May, is going to step down. He's technically on the board until January 2028. So he might just decide to be a prick to Donald Trump. Obviously Donald Trump's been a prick to him. So he just might be a prick and stick around and fold his arms. That's a possibility. Like, it's ridiculous as it sounds, that's a possibility. So just expect the Fed chair in waiting to be named at some point in the next few months, now that the seat is open. I mean, it could come as soon as next week. Who knows? We don't. President Trump doesn't sleep, so he could be on this as soon as next week. So be aware of that. The latest jobs report was supportive of our U-shaped economy thesis. July concluded the worst 2-month stretch of private sector labor income growth since 1Q 2024. So private sector labor income That's the sum product of private sector employment, private sector average hourly earnings, and private sector average weekly hours. And so we got the sum product of that was 3.4% on a 3-month annualized basis. Obviously, well below trend for the past 2 months. And so it's the first time since Q1 of 2024 we have 2 consecutive months of below trend private sector labor income growth. And by the way, private sector employment is now contracting at minus 0.4% on a 3-month annualized basis. That's the lowest print we've seen since November. So, we got some problems brewing in the labor market. We talked about this last month. And say, hey, we got to the lowest level of private sector labor income we had in over a year. And now it's 2 consecutive months that we're starting to see this. And the reason this matters is because our private sector labor income metric tracks nominal wage and salary compensation like a glove. I mean, they've been highly correlated since the 50s, 1950s. And so it's suggesting that we're in this rough patch of below trend nominal wage and salary compensation, which means we're going to be in a rough patch of below trend consumer spending. Labor supply is collapsing, which is artificially suppressing the unemployment rate. So if you look at the labor force participation rate, that's ticked down to 62.2. That's the lowest since November of 2022. The employment to population ratio ticked down to 59.6%. That's the lowest since December of 2021. And the civilian labor force is now contracting at a minus 1.9% pace on a 3-month annualized basis. That's the lowest print we've seen since January of 2021. I mean, this labor supply is collapsing. So we're essentially removing a lot of unemployed people out of the mix. And so it's holding down the unemployment rate. But the reality is the unemployment rate would be higher right now if we had more, if labor supply wasn't collapsing the way it is. And so, the Fed is kind of missing the signal, in our opinion. The labor market is deteriorating from a sectoral breadth perspective as well. So if you look at the share of the growth of non-farm payrolls that is going to what we call government and government adjacent industries. So that's federal, state, local government, education, healthcare, and social services. So anything that really, is highly connected with the government spending in terms of the end source of demand. We're now at 81% of the growth of non-farm payrolls since President Trump took office is government and government adjacent employees. That's actually higher than it was in the last 2 years of the Biden administration. The pre-COVID trend in this metric is 31%. We're more than double. We're almost a triple in terms of the share of jobs growth that is coming from government and government adjacent industries. So what does that obviously tell you is that we've very anemic growth coming from the actual private sector, the business side of the economy. And so that's a signal as well that they're ignoring. The latest PCE report was supportive of our U-shaped economy thesis. The June concluded the worst 5-month stretch of real services PCE growth since early in the COVID crisis. So real services consumption slowed to a well below trend level of 0.9% on a 3-month annualized basis in June. We got the PCE report on Thursday. Worst 5-month stretch since like the 5 months in the initial part of the lockdowns of COVID. We're having COVID type levels of services consumption. How are they missing this? How are they missing the Q2 GDP report was supported by our U-shaped economy thesis? Real GDP ex government and net exports, so like the GDP that actually matters to the financial markets, slowed to minus 3.2% on a quarter-over-quarter SAR basis in Q2. That's the lowest rate since Q2 2020 when we shut the whole country down because of a global pandemic. How are they missing this? This is like headline stuff. I mean, you got to do a little bit of math to get to these conclusions. But come on, they got 400 PhD economists over there. Secretary Bessent, hello, Scott, if you're watching. Still watching, obviously, former client. He said something that, and I don't want to be pejorative. I'm obviously fired up and passionate about this. He said something that triggered me in a good way when he was on CNBC, not last week, but the previous week. He's like, they have 400 economists over there. What are they doing? Why do they keep having so many bad outcomes? Like he said, it was universal basic income for academic economists. And I'm like, that's actually kind of a hard bar. He's had a couple of hard bars recently, Caracas on the Hudson. But that was a hard bar. I was like, yeah, like, what are they doing over there? How do you make this many policy mistakes? You over-tightened in 2018. You were slow to tighten in 2020. You were slow to tighten in 2020. Slow as that any policy mistake maker in history in 2022. And then now you're slow to cut in 2025. That's 4 major policy mistakes in one Federal Reserve chair's regime. You have 400 PhD economists. What are they studying? Whatever they're studying, whatever they get in their PhD degrees in is not working. I would pivot to physics or history or or maybe sports science. I don't know. I don't even know what they're studying, but I know if it's macroeconomics, it's not working. The legacy themes, the Phillips curve, all this gobbledygook that they tried to teach me at Yale that I said, nah, that sounds stupid. And guess what? It is stupid. All this stuff, it's not working. The data will tell you what you should be doing from a policy making standpoint. They claim to be data dependent, but I'm on slide 58 telling you that they're not. The Q2 GDP report was supportive of our U-shaped economy thesis. Private real final sales growth slowed to 1.2%. That's the lowest rate we've seen since 4Q 2022. Does it have to go negative, Jay, before you cut rates? The U-shaped economy affords the Fed a window in which to resume lowering the policy rate. Not cutting will tighten financial conditions. And by the way, actually, no, I got a slide on here. I'll explain what I'm about to say. But anyway, so the market is currently pricing in 50 basis points of rate cuts between now and December of 31st. Every day that goes by that they don't cut rates, the market's going to get nervous if they're not going to cut. And so we got to price out these rate cuts or push them into 2026. Both of those represent a tightening of financial conditions. And so ultimately, if the Fed doesn't start to cut, especially in response to all this data, then the markets are going to get really uncomfortable and nervous. And for what? So we can get 2% inflation? Why? Why 2? We'll talk about why 2, but let me get to this point. Reminder, inflation is by far the most lagging indicator of the business cycle. Anchoring quote unquote data dependent policy on future pending inflation data is a policy mistake. If you're anchoring your quote unquote data dependent policy on future values of the most lagging indicator of the business cycle, that is a policy mistake. I don't even care what the numbers are going to be. That you're already doing it wrong. You're driving backwards. You're on it's like you're driving in the wrong direction on a one-way street. And fun fact, I was in probably middle school. There's a British lady who was driving down the wrong way on a one-way street in Seattle, and I literally had to jump out of the way before she hit me and landed on the sidewalk. And she was obviously mortified, and she didn't realize she was driving the wrong way down the one-way street. And Jay, you might be driving the wrong way down a one-way street. Please don't hit any kids. So for those who may not have been familiar with this analysis, this is probably the seminal conclusion from our business cycle. We did a deep dive study on the U.S. business cycle. So I'm not a big fan of academic economist theories and gobbledygook. I'd like to look at empirical data. If it's not observable in the data, then it doesn't exist, in my opinion. I don't believe in theories. I believe in empirics. And so we said, okay, well, how does the business cycle actually work? I don't care about the books tell me. What is actually occurred in the economy? And so we did a deep dive study to analyze hundreds of time series to identify, okay, how do they, which ones lead, which ones lag, which ones are coincident with the business cycle. And so the key takeaway, the main takeaway from that study, there's plenty of takeaways, but this is the big one, is that there is a pattern to which how the business cycle works. It's not, we don't just pop into an expansion or pop into a contraction. We don't go to recession. We don't go to recovery. We just, it's not random. There's a sequence to how the business cycle has historically worked. So what I'm showing here is the median trailing 10-year delta adjusted Z-score for each of these cycles that comprise the business cycle. There's a bunch of cycles within the economy that comprise the business cycle. And so essentially with that, that sounds mathy. What it essentially is the median path that each of these cycles takes into and through a recession. And so how the business cycles historically worked, and there's 12 post-war business cycles that represent the median for each of these cycles. So policy tends to get restrictive. It's called 15 to 18 months ahead of a recession. And corporate profits break down 12 months ahead of a recession. Then liquidity breaks down 3 quarters ahead of a recession. And growth in stocks break down simultaneously 2 quarters ahead of a recession. Then the unemployment rate breaks out right when the recession starts. So again, everything's delta adjusted. So down is bad for the business cycle, up is good. Unemployment rate breaks out right when the recession starts. That's when the NBER notice. That's when the baggy suit wearing economists notice, and they put the red bar on the chart after the fact. And then credit delinquencies, charge-offs break out quarter after the recession starts, and then inflation, the most lagging indicator of the business cycle, breaks down 12 to 15 months after a recession has already started. Jay, if you're waiting for inflation to break down, we will have gone through a recession already. Are you willing to are you willing to hit some kids driving down the wrong way on a street? Are you willing for you maybe promised us pain in 2022? Are you willing? You want your legacy to be pushing the economy into a recession years after you let the inflation genie out of the bottle. Now you want to push us into the recession? Not then. It's just so stupid. Anyway, I'm glad you guys have fun with me. So the key takeaway is, inflation is not going to break down durably below trend without a recession. Like, we're not going to get durable, sustained 2% inflation. The economy is going to stay above trend from an inflation perspective. We keep trying to break down. We tried to break down back in the middle of 2023. We tried to break down back in the middle of 2024. We tried to break down in the middle of 2025. But we can't do it. And the reason we're not doing it is because we haven't gone into a recession. You need the recession for people to stop raising prices. You need it. That is the signal for companies to stop pushing prices to the consumers. Demand needs to be destroyed. And so people like making money. So they're going to keep trying to make money until you tell them to stop, until the recession tells them to stop. Core PC deflators at 2 points popped up back to 2.6% on a 3-month annualized basis. That number's above trend. Oh, by the way, actually, I'll make that part. I have so many points to make, but it's all on slide 64, so I'll save them. If you look at super core PC, which accelerated modestly to 1.8%, the number's still below trend. This is 2 consecutive months of below trend super core PC growth on a 3-month annualized basis. It's the first time we've had that in the time series since 2019. 2019. They cut interest rates 100 basis points last fall, and we did not even have this outcome. The last time we had this outcome in terms of 2 consecutive months of super core PC inflation, which is the inflation statistic that Jerome himself in 2022 told us is the number one inflation statistic the Fed has control over. This is now at its lowest level on a 2-month basis since 2019. And they cut 100 basis points last year. Now you have this outcome and you won't cut 25 basis points? I don't understand it. Doesn't it seem like there's a change in the reaction function from one administration to the next? It seems like it to me, because he had no problem taking the Fed's balance sheet 36% of GDP and keeping the policy rate 1,000 basis points below what the Taylor rule suggested in 2021 in the previous administration. Now he's the biggest hawk on the planet in the current administration. I don't get it. I don't get it. Why did the reaction function change? Why did it change? Someone tell me why it changed. Oh, that's right. It's because he let the inflation genie out of the bottle, and now he's trying to protect his legacy, so he goes out like a hawk. Underlying inflation is unlikely to return durably to trend without an actual recession. So we have not even sniffed breaking down below trend over the past several quarters in median PCE and trim mean PC deflator. We're at 3.4% and 2.8% on a 3-month annualized basis, respectively. And so part of the reason we can't break down below trend, and if you look at the glide path on inflation, like this is the year-over-year rate of change of inflation, the red line and the black line is 6-month annualized. Look at the glide path on inflation. Isn't that exactly what we've been telling you to expect based on this model here since January of 2022? We told you this is an economy that wants to have 3% inflation. If you look at all the factors in the economy, they're just the change in all these coincident and leading indicators of inflation and how they're performing in this model suggests that we should be having an equilibrium level of 2.9% core PC inflation, which is exactly what we've observed in the time series over the past few years. And again, we made that call in January of 2022. We finished bottom, and consensus was expecting this back to normal. We're not going back to normal until we go into recession. That's what the call we've been making since January 22, and I don't think we're going into recession. It's not, it's not real, but we are the worst part of we're in, and will continue to be in the worst part of the U-shaped economy for the next, let's call it 6 months. And so if the Fed doesn't play ball, the markets will correct. If he says anything about tightening, the markets will crash. I don't think that's a high probability outcome. I think the Fed, Trump will nominate his replacement immediately that day. So the markets will immediately tune Powell out and start to price in whatever, Kevin Walsh or Kevin Hassett or whoever, maybe it's Secretary Best. Who knows? I don't know. We'll find out. But the key takeaway from this slide and the key takeaway from today's presentation is our secular inflation model continues to signal the equilibrium core PC inflation rate is in the high 2s, low 3s. So equilibrium being the horizontal line in this, kind of stylized diagram. So inflation obviously goes up and down. What's the equilibrium level? Where is it going up and down from? So our model, that's for 3 years now, three plus years, signaled that it's a kind of high 2s, low 3s type number. And so unless AI catalyzes a disinflationary productivity boom, of which it'll be somewhere close to two. So the Fed's arbitrary 2% inflation target implies its policy setting is too tight for consumers and businesses on the bottom part of the K. We've been advocating for that. Obviously, the president is advocating for that. And so that's one of many reasons, not the most important reason, but it's one reason why we think Fed independence will get eroded over a long period of time, because the administration is trying to engineer an economic boom in paradigm C. And one of the ways you can do that is to, obviously create more dovish monetary policy outcomes. But the most important reason why we think the Fed's independence will get eroded over time, much like we did from 1942 to 1951, when they yield curve control capped the short end rate at 37.5 basis points and the long end rate at 2.5% for 9 years. The last time we saw a significant erosion of Fed independence was in the previous fourth turning. And we are currently in a geopolitically driven supply and demand imbalance in the current fourth turning that will ultimately require an erosion of Fed independence to solve. They're not going to let the Treasury bond market blow up. They will lose independence to save the Treasury bond market, because guess what? The Fed works for us. Well, maybe it doesn't work for us as in, us regular people, but it is a function of the U.S. The Fed's not going to sit there and watch the United States economy just blow up because the bond market's blowing up. It's going to be forced into action. So just be aware of that. That's why KISS stocks go Bitcoin. So, we're waiting at the finish line. But anyway, getting back into this, and I'll let you guys go. So how does this model work? This model interpolates the normalized change in these leading and coincident indicators of inflation upon the underlying, unit root of the core PC inflation time series to figure out, okay, is the time series, transposing higher or lower over time to meet the equilibrium level. And so on an unweighted basis, and so let's just go down the features. So right now, if you look at AI, we proxy AI as NASDAQ 100 market cap as a share of Russell 2000 market cap. So what's the market cap of the companies most exposed to AI relative to the broad U.S. equity market? And that's currently 46%. And so that's applying a meaningful amount of disinflationary pressure upon the time series, upon the core PC time series. Automation, we proxy that as CapEx divided by employee compensation. So that's 27%. That's applying a modest amount of disinflationary pressure. Commodities, we proxy that by the CRB index. That's applying a modest amount of inflationary pressure. Deglobalization, we look at the imports of goods and services as a percent of GDP. The latest value is 14%. That's applying a modest amount of inflationary pressure. Demographics, the share of population that's 65 years and over, so people who are unlikely to work, exiting the labor force. Or sorry, obviously their demand curve is declining as well. So the latest value there is 17%. That's applying a modest amount of disinflationary pressure. The Fed reaction function, if we look at the Fed's balance sheet as a percent of GDP, that's 22%. That's applying a modest amount of inflationary pressure. The fiscal policy, if you look at the fiscal balance, the sovereign fiscal balance as a percent of GDP, the latest value is minus 6.3%. That's applying a modest amount of inflationary pressure. House prices, if we look at the FIFA house price index, the latest value on a year-over-year basis is 4%. That's essentially not applying any inflation or disinflationary pressure. Housing supply, if we look at household formation divided by existing home inventory, the latest value is 0.8 ratio. That's essentially a wash in terms of inflation. If we look at income inequality, the Gini coefficient is 0.49. That's applying a modest amount of inflationary, modest amount of disinflationary pressure. So you're essentially pricing out poor people from being able to buy stuff. That's why the electoral college map looked the way it did. Labor supply, labor force participation, that latest value is 62.2%. That's applying a modest amount of inflationary pressure. So we're losing labor supply. So obviously that's a positive influence on wages over the long term. Money supply growth, if you look at into on a year-over-year basis, the latest value is 4.5%. It's applying a modest amount of disinflationary pressure. If you look at money velocity, so M2 divided by nominal GDP, that latest value is 1.4 as a ratio. That's applying a modest amount of disinflationary pressure. If we look at monopsony power, so S&P 100 market cap divided by S&P 500 market cap, the latest value is 72%. So the top 100 companies in the S&P 500 represent 72% of the market cap. That's applying a meaningful amount of inflationary pressure. So essentially, the more monopsonies you have, the more pricing power they have. And the more pricing power they have, the more they can raise prices. And so that's adding a meaningful amount of inflationary pressure. We look at populism. So we look at the employment to population ratio of the 25 to 54, the prime working age population, employment to population ratio at 81% is applying a modest amount of disinflationary pressure. And so, as that goes up, you're essentially saying, as the employment to population ratio goes down, you're going to get more populism. So it's going up. It's actually gone. It's actually, I think it's at an all-time high. So it's applying disinflationary pressure. Productivity, if you look at output per hour, so of non-farm, the productivity growth is 1.3% on a year-over-year basis. That's essentially a wash with regards to inflation. Public debt, if you look at federal debt held by the public as a percentage of GDP, the latest value is 106%. That's applying a meaningful amount of inflationary pressure. You look at wages, the employment cost index, the latest value there is 3.6% year over year. That's applying a meaningful amount of inflationary pressure. And then the West Village Montauk effect. For those who may be new, the West Village Montauk effect is a phenomenon that we identified in the economy back in 2023 to support our resilient U.S. economy. Well, we identified it and recognized that it would support our resilient U.S. economy theme and has for a long period of time. And so what the West Village Montauk effect is essentially we have such a high stock of savings on the household sector balance sheets as a function of the historic fiscal and monetary largesse we've seen since COVID. The checkable deposits and currency as a percent of total household assets is now 3% of total household assets. It's the highest percentage we've ever seen in the time series, data going all the way back to the 50s. That's applying the most amount of inflationary pressure. And the reason why is because we have all this cash sloshing around in people's checking accounts that can go be spent into the economy at any given time. So this is part of the reason why the economy's been resilient. And the origin of this, the reason I was able to notice this and without a, academic economist, PhD, the econs of the Fed don't even realize this, but the reason I was able to notice this is because I'm someone who, spent a lot of time partying in West Village and Montauk. And you realize, that the people who spend the most money in these places at Surf Lodge and Common Ground, the people who spend the most money aren't the richest people. It's the people whose mom and dads are the richest because they can spend a higher share of their income into the economy week after week, month after month. If your mom and daddy already saved all the money that you're going to need to retire with, you can take 100% of your Wall Street analyst or associate income and spend it on bottle service. But people like me who have to, send money back home and actually grow a nest egg for my family, I can't spend all my money on bottle service because I actually have to save money. And so the reverse of that is true as well. Is if you already have a bunch of money in the bank, you don't need to keep saving money. And so that's why the savings rate has been structurally depressed throughout this entire business cycle. That's why consumer spending has been relatively resilient throughout this business cycle, because they're relatively resilient, certainly relative to the elevated policy rate. And that's because we have all these savings on household sector balance sheets. Now, it's obviously not evenly distributed. It's obviously we have a big K-shaped economy in the top part of the K. If you look at the top third of consumers account for 51% of consumer spending, whereas the bottom third of consumers only account for 15% of consumer spending. So, it's a very unevenly distributed K, but the reality is that was all contributing to the resiliency of the economy. But this is contributing to a high level of inflation. And so the key takeaway is that this is an economy based on all these factors. I've been talking for 10 minutes here. All these factors, the economy just kind of wants to have high twos, low threes inflation. But the Fed has this arbitrary 2% inflation target that it got from some dead central banker in New Zealand. And so, of course, they're going to run monetary policy too tight because they're trying to get to a level of inflation that is, quite frankly, asinine in the context of everything I've been talking about. And so, the only way you can really win here is if you're the Federal Reserve, they can get lucky on the productivity boom because what I did in the model is I said, okay, on the unweighted model, weight all the factors evenly, the economy wants to have 2.9% core PC inflation on an equilibrium basis. But if we weight AI for 50% of the weight and then give all the remainder, the residual to all the other factors on an equal basis, so AI is now 50% of the model, that's how you get to an equilibrium core PC inflation level of 2%. So we literally have to have a disinflationary productivity boom for the inflation to durably rest at the Fed's 2% target without a recession. So if that's the outcome they're betting on, they're going to make a policy mistake. Because otherwise, this is why I've been saying, you've got to let they got to change the inflation target. The inflation target has to be 3. If you keep it at 2, it's going to create negative outcomes. That's part of the reason why we have a K-shaped economy. And, oh, by the way, everybody that goes, Darius, if they revise the inflation target to 3%, won't that destroy the bond market? And I'll say the exact same thing to you that Mariner Eccles and Thomas McCabe said to the bond vigilantes back then, which is, nope, you're going out of business. I'm going to buy every bond in sight that's above 2.5% yield, which is what they did for 9 years. The Fed could easily say, we're going to cap the 10-year treasury yield at 3.5%, and every bond on earth that's trading above 3.5% is going to be bought and sold to the Fed. You don't think there's going to, I will start a hedge fund to buy every treasury on earth to sell to the Fed if they're going to cap yields at some point, which is exactly where I think we're headed over the long term. It may not get there over the next few weeks or months or the next couple of years, but that's where we're headed by the end of this fourth turning poly crisis. I guarantee it. So we'll wrap it up there. Darius Dale here presenting our Around the Horn for Saturday, August 2nd, 2025. Best of luck out there. Actually, have a great weekend. Remember, if we're starting to correct, just think about this shirt. Go to the beach. We're still in paradigm C. Unless you hear me say we're going back to paradigm B, you got to assume the dip will be bought. And so we'll catch you back here next week. Have a great weekend. A lot of stuff positive when you think about it from a paradigm C perspective, a resilient U.S. economy perspective. There's a lot of stuff positive over a medium to long-term time horizon. So again, 3 to 12 months is medium term. Long term is 12 plus months. If you think about the medium to long-term time horizon, a lot of positive stuff with liquidity, with paradigm C, with resiliency of the economy. But over a short to medium-term time horizon, we have bearish quadratic model signal. We got bearish positioning model signal. They're the worst part of the U-shaped economy. And then we're going to start to get data that confirms our sticky inflation theme. So, is the correction over? I don't know. Perhaps it isn't. Perhaps it's not. Doesn't matter. Just dispassionately execute KISS and Dr. Mo if you want to stay on the right side of market risk. So let's unpack the fundamental portion of the program before we wrap up. Are markets adequately pricing regime change at the Fed? No. The real floor Fed funds rate is currently 50 basis points, positive 50 basis points. Investors should expect it to decline to negative 50 basis points by December of 2026. For what it's worth, it's already declined by 100 basis points year to date. So the real floor Fed funds rate, which is the floor Fed funds rate, so the nominal floor Fed funds rate, which is the minimum value on the overnight index swap curve about 2 years, is currently 3.12%. If you deflate it by the 2-year tips break even, we're somewhere around 49 basis points. So about 50 basis points of real floor Fed funds rate. We think this 50 basis points will be minus 50 basis points by December of 2026. Doesn't mean the Fed funds rate itself will be minus 50 basis points, but we think by the end of next year, there will be enough forward guidance in the market for the market participants to price in a durably negative real Fed funds rate. That's in our view, that's a high probability outcome by the end of next year in the context of the regime change that we continue to call for and observe with regards to the Federal Reserve. Investors can debate what the appropriate level of R star is until they're blue in the face. But one thing that is not up for debate is R star is not a fixed value. It must evolve as the economy evolves. And so in this chart here, we show R star from the Lombard-Williams model. So R star is essentially what the real policy rate is, kind of that neither causes the economy to create inflation or cause the economy to create unemployment, kind of from a structural standpoint. The neutral rate is sort of R star from a cyclical standpoint. So like, what is this current economy? What's the appropriate level of policy for this current economy? The Fed is always setting monetary policy with regards to the current economy from a cyclical standpoint. But R star is more of a structural concept, same concept, but just think about like just the U.S. economy in general, like how much population growth we have, how much productivity growth do we have, like what's an generally appropriate level for the real policy rate. And so right now it's R star, the Lombard-Williams model says it's plus 78 basis points. In our opinion, that's probably too high. And the reason why it's too high is if you look at the refinancing risk in the credit market, so this is this shaded area curve, is the basis point spread between the yield of the investment grade corporate credit index and the coupon of the index. So the coupon is what the borrowers pay. The yield is what the price is in the market. So when they refinance, they're going to refinance into a higher interest rate regime. And so that's positive. It peaked at over 200 basis points back in like late 2022. It's now 56 basis points, but look how long it's been positive. Like typically it's like positive for a little bit. If you look at the last few cycles, it goes positive in recession or right before recession. We've been positive for years. And so I think that's a supportive of our resilient economy theme. There's something going on in the economy that's preventing us from going into recession with this condition. And guess what? It's exactly what we've been telling you. It's fiscal dominance. It's the fiscal dominance regime. It's both preventing us from going into recession, but also causing a structurally elevated level of refinancing risk in the corporate credit market. And the reason this is a problem is because obviously the big companies, and they have a cheaper cost of capital, and they can extend their duration on that capital much better than smaller companies. If you're a small to medium-sized enterprise, you're going to have a higher cost of capital. You're more likely to be financing with bank credit as opposed to the bond market. And then you're also more likely to have shorter duration capital, which means you're constantly refinancing into this higher interest rate regime. Again, every day you go forward, we've been refinancing into a higher interest rate regime. Now the slope has changed, but the key takeaway is that it's still positive. And so ultimately that just makes it harder and harder for the businesses at the bottom part of the K-shaped economy to grow. And so you're basically, the fiscal dominance is contributing to the K-shaped economy. And so ultimately you just need monetary policy to offset that. And if they don't offset that, then we're going to have sluggish growth for the consumers and businesses on the bottom part of the K, period. That's it. Investors can debate what the appropriate level of R star is until the cows come home. But one thing is not up for debate. R star is not a fixed value and must evolve as the economy evolves. Again, R star is not a fixed value. It peaked at 4.35 in 1973, and it's 0.78 now. So obviously it's variable. So if you're Jay Powell or if you're someone at the Powell Fed, it's like, well, R star is 50 basis points. Says who? Darius is telling you it needs to be lower. The red line moves up and down. So I'm making a very credible case that we're going to maintain a K-shaped economy where the consumers and businesses on the bottom part of the K are going to be trapped out of, corporate credit in terms of being able to expand their businesses, and the folks on the bottom part of the K in the housing market are trapped in the housing market. This is the same analysis. So the basis point spread between the yield and coupon for the mortgage-backed securities asset class, and so refinancing risk has been persistently positive here. In fact, this current 151 basis points spread between the yield on the MBS index versus the coupon, it's the highest we've seen since the mid 80s. Highest we've seen since the mid 1980s. That's how much refinancing risk we have in the housing market. And so if the Fed is not playing ball from a financial repression and monetary debasement standpoint in the context of fiscal dominance, the Fed's not using its balance sheet to offset the draining of capital into the treasury market and away from the mortgage market and away from the credit market, then we're going to keep this K-shaped economy and maintain sluggish growth. If you go back and you look at, we talked about this last week, but if you look at the share of jobs that were created by government and government adjacent sectors in the last 2 years of the Biden presidency, was 73%. And in the first 6-7 months of the Trump presidency, it's 81%. There's hardly any private sector job creation for almost 3 years now. It's because of this. It's because the Fed doesn't understand the role they have to play in a fiscal dominance regime. The Fed still thinks we're in a monetary dominance regime and that they're in charge. No. The treasury market is the captain now, Jay. Figure it out, please. Macro markets understand this is an economy that requires financial repression and monetary debasement because of fiscal dominance. So if you look at year-to-date performance, guess what's leading? You take a guess. No, just guess. Don't even look at the chart. Don't look at the chart. Guess. Guess what's leading year to date? Stocks, gold, Bitcoin. Stocks are up 8%. Bitcoin's up 25%. Gold's up 29%. Macro markets understand this is an economy that requires financial repression and monetary debasement because of fiscal dominance. Look at 2024's performance. Before you look at the chart, guess what led in 2024? If you guess stocks, gold, Bitcoin, you're right. Stocks are up 24%. Gold was up 27%. Bitcoin was up 121%. Macro markets understand this is an economy that requires financial repression and monetary debasement because of fiscal dominance. Look at 2023's performance, Jay. Guess what outperformed in 2023? And by the way, we started KISS back in January 2023. So congrats to all of you who've been participating and getting richer alongside me for the past 2.5 years. I'm a lot richer than I was in January 2023 because of KISS. I know a lot of you guys are as well. So congrats. Guess what led in 2023 as well? Stocks up 25%, gold up 12%, and Bitcoin up 157%. I mean, this is the new reality that we're in. The markets are telling, this is a very clear signal that the markets need financial repression and monetary debasement to resolve these K-shaped problems. And so we ultimately need regime change at the Fed to facilitate that outcome. The July New York Fed survey of consumer expectations data supported our sticky inflation theme and our secular inflation model projection for the equilibrium rate of core PCE, which is currently 2.9%. Consumers already expect structural 3% inflation, which is why they need faster real median wage growth. It's not about an arbitrary 2% inflation target that we got from some dead central banker in New Zealand who might have been eaten by a shark. That happens down there, by the way. It's not about 2% inflation. We need real median wage growth. Who cares what the inflation rate is? What we need is real median wage growth, period. The Fed should be targeting that. That should be the Fed's only mandate, is real median wage growth, period. In fact, Congress, if anybody from Congress is listening to me right now, change the Fed's mandate to real median wage growth. Should be the only thing we care about as a society, period. Stop caring about GDP and inflation and unemployment. These are all nonsensical statistics. What matters is how the regular man, the working class person's life is getting better. Is it getting better or is it getting worse? We got to start creating better policy outcomes. So anyway, I'm obviously very passionate about this as someone who grew up on the very bottom of the K-shaped US economy. I'm going to use the skills that God gave me to try to enact policy change at some point. Maybe I'll be president, maybe I'll be treasury secretary, or maybe I'll just be governor of New York. I don't know. Who knows? But we'll figure it out. We'll figure it out. But for now, I'm obviously here with you guys, and not fully. My promise to you guys is, KISS will be set it and forget it from a technology perspective well before I decide to foray into politics to try to fix some of these ridiculous problems. But anyway, getting into it. So if we look at the New York Fed survey of consumer expectations, so this is the 1 year median CPI expectation, 3 year and 5 year. 1 year is 3.1%, 3 years 3%, 5 years 2.9%. 2.9% is exactly what our secular inflation model is saying the equilibrium quote PC inflation rate is. 2.9%. So consumers, as surveyed by the New York Fed, the one who does the SOMA portfolio, the consumers think inflation is just 5% or 3% over the next 5 years. So give them, they already know that 2% inflation is a myth. They already know it's a myth. You're lying to them. They know it's a myth. So instead of lying to them and maintaining too tight policy that causes too sluggish growth for the consumers and businesses on the bottom part of the K, run policy that allows growth to happen so that they can overcome this 3% inflation. The world is just structurally inflationary now. And so the only way to offset that is to have growth. You need growth. Stop fighting growth. Stop creating a growth recession, Jay, for your arbitrary 2% inflation target. Keep moving here. We are not alone in calling for regime change at the Fed. So this is Fed Governor nominee Steve Moran, Dr. Moran, brilliant man. He's sort of the architect behind a lot of what's happening from a policy perspective in terms of articulating the academic economist theories behind a lot of what they're doing from a trade policy standpoint, deregulation standpoint, and hopefully eventually monetary policy standpoint. Not saying I agree with everything they're doing. I very clearly do not. But what I will say is this: if you want a good steady hand to join the Fed to kind of help usher in regime change, there's not too many people in the world smarter than this dude. So it'd be great to see him get in there. So let me read some of his recent commentary that give you a sense of kind of how he might be influencing policy, the direction with which he might be influencing policy over the medium to long term. So I'll start with this one, which we unpacked in the executive summary, which is overall, we don't expect significant inflation from tariffs. And if it occurs, it will be a one-time price level shift, not an enduring trend. This is the exact opposite of what Jay Powell is saying. Jay's like, well, it could be an enduring trend, even though all of our academic research says it's not going to be. It might be because I let the inflation genie out of the bottle. Anyway, also Dr. Moran read, so he's obviously wrote the user's guide to restructuring global trade. So that's obviously one of the most read white papers of all time from last fall that talks about the tariff regime and the pending tariff regime and the reorganizing of global trade that we're currently experiencing as investors. He wrote a paper in March 2024 titled "Reform the Federal Reserve's Governance to Deliver Better Monetary Outcomes." So I'm not a kook. I'm not crazy. I'm not wearing a tinfoil hat who's sitting here with my own academic research process that says we need better monetary policy outcomes. We have people in the chair of the Council of Economic Advisors, who's now a Fed governor candidate, also agrees that we need better monetary policy outcomes. So as critical as I might sound of the Jay Powell Fed, I'm not the only one. I'm not crazy. I'm just observing with hundreds of slides of data every week that the Fed is creating terrible policy outcomes. And so we need to change how they operate. We need to change. So they outline 5 major policy reform initiatives in that paper. Obviously, not all are going to come true, and certainly not all going to come true over short to medium or medium to long-term time horizon. But just think about this as where we could potentially be headed in the future in the context of our paradigm C view. So they want to separate the non-monetary functions and strengthen oversight. They want to shorten terms and enable at-will removal of Fed governors and regional bank Fed presidents. They want to curtail the risk of political posturing, so prevent Fed officials from, kind of cozying up to executive officers, executive branch. They want to replace private influence with state-level accountability. So I think that was really important. They want to transform the reserve banks from privately influenced institutions to publicly accountable bodies. The Fed needs to be accountable. They have such a big impact on the outcomes that consumers and businesses feel, not just in our economy, but in economies across the world. Why are they not accountable? Why are they separate and apart from the political process? Why can't we have some accountability with monetary policy making? This stuff matters to everyone on earth. Yet we have no accountability. Come on, it's nuts. Expand F1, and then they want to expand FOMC voting to all regional bank presidents. So they want to kind of create this kind of decentralized Federal Reserve by giving more power to the regional bank presidents. So I don't think you would have a hard time to find somebody who's thoughtful and balanced to disagree with any of this. The people who are going to disagree with this stuff, the Nick Tiramoses of the world, I'm talking to you, Nick, the people who are, they're part of the legacy institution. They get paid to defend the Fed. But the reality is the Fed is not an institution worth defending. They're creating terrible policy outcomes for consumers and businesses on the bottom part of our K-shaped economy and have been for decades. We need reform. And I'm not the only one. The reform drumbeat is circling the Fed, and it's coming, whether you position for it in your portfolio appropriately or not. KISS is obviously well positioned for reform at the Fed. You may not be, but I am, and the people following KISS listening to me talk are. So let's keep moving here. We're not alone for calling for regime change at the Fed. It's obviously Treasury Secretary Scott Bessent. We talked about his commentary in the macro scouting report. What we need to do is examine the entire Federal Reserve institution and whether they've been successful. Has the organization succeeded in its mission? If this were the FAA, we would not be having this, and we were having this many mistakes. We would go back and look at why has this happened? Why are we having this many mistakes? You have 400 PhD economists over there. In fact, he said, all those PhDs over there, I don't know what they do. It's like universal basic income for academic economists. Bombers. And then finally, Kevin Warsh, Fed chair candidate Kevin Warsh. He's got a lot here to say. I'll let you read it on your own time. I'll just read the bold commentary. That's our emphasis. It says, this is a hinge point in history. I think the president's language is that this could be a golden age. A central bank stuck with models from 1978 and one that doesn't recognize we could be at the front end of a productivity boom, which would obviously be disinflationary. The broad conduct of monetary policy has been broken for quite a long time. We don't need policy continuity. That continuity brought about the greatest mistake in macroeconomic policy in 45 years. The dominant models of the Fed, which may have been the best in 1978, well before I was born, still assume that inflation happens when the economy runs too hot and workers get paid too much. That's not my view, and that's not my view either. So thank you for saying that, Kevin. So keep moving here. The U.S. dollar may be front-running eventual regime change at the Fed. So you've seen this chart before. So this is the bottom panel here is the OIS-derived floor Fed funds rate out 5 years minus the current Fed funds rate. So the market's currently pricing in 5 rate cuts to the floor Fed funds rate. If you look at the 10-year Treasury yield, that's the red line there. And then the dollar is the green line. As you can see, since Liberation Day, the dollar has been creating distance between itself and policy rate expectations, both on the short end of the curve and on the long end of the curve. Prior to Liberation Day and for the previous few years, Dow was trading in lockstep with expectations on both the short and long end of the curve, which tells you that the short and long end of the curve were trading in lockstep too. But since then, you've seen this breakdown in the dollar relative to those time series. And so in our opinion, we think that's evidence of the currency market starting to front run eventual regime change at the Fed in a way that interest rate markets probably cannot yet because we haven't got the policy guidance from Fed officials. U.S. dollar money markets have already begun pricing in regime change at the Fed. So if we look at money markets, so this spread here is the yield on December 2026 SOFR futures minus the spread on March 2026 SOFR futures. So end of next year versus the last meeting before Jay is done at the Fed. And as you can see, this deeply negative spread suggests that the markets are pricing in whoever comes in after Jay and takes over the Fed chairmanship will be successful in implementing, catalyzing a much more dovish monetary policy. In our opinion, and ultimately, we don't think that monetary policy pricing is dovish enough in the context of a positive 50 basis point real floor Fed funds rate that we still think is going to be 100 basis points lower by the end of next year. So I would position for that if I were you.